New economic good news out of Europe? Am I dreaming? Germany, the powerhouse of the EU economy, reported slight growth in the second quarter of this year. Meanwhile, preliminary figures show a half-point growth in the EU for the same period. All of that following the first positive reading of an important measure of the manufacturing and services sector in months. I'm hesitant to say it, but is the EU economy in recovery? I'm Cassandra, and you've tuned into The Dip, the podcast that looks at money, power, and consequences. And today, I'm trying to figure out if the European economy is finally bouncing back, or if after years of energy problems, inflation, and now a U.S. war in the Persian Gulf, if we are just one more geopolitical debacle away from a full-blown crisis. Today, to help me dive in, I'm joined by Carsten Brzeski. He's the chief eurozone economist at ING, and I have a feeling he might think that some of my celebration might be a bit too optimistic. And I'm also joined by Carole Nakhle. She's the CEO of Crystol Energy, an independent advisory looking at oil, gas, and energy markets. And she's going to help us key in on one very, very important factor here to this whole conversation, and that's energy. Hello to you both. Thanks for joining. Carsten, speaking of news, when you wake up and read the news, what's the first thing you're looking at as Carsten the citizen as opposed to Carsten the economist?
Carsten, the citizen, probably is always following what just has happened overnight in the US, because this is both the economist and the citizen. And actually, in all honesty, Cassandra, the citizen always checks the sport news because that's something, it gives nice distraction as well.
Fair enough. Well, we think we all need a little bit of distraction from time to time. But Carsten, usually it's bad news that comes in threes, but we got 3 bits of good news here. Zooming out and looking at some of this recent data that we've had, what's your read?
Well, I loved your intro, Cassandra, because this was really kind of optimistic, maybe a bit too much, but a nice change of tone, because it looks a little bit as if the mood, the sentiment in the European economy has clearly been worse than the actual figures, because we had interesting, surprisingly strong GDP data in the second quarter. So instead of the European economy flirting with recession, in the midst of the war in the Middle East, confronted with higher energy prices, we've seen growth. And that has been a clear, nice, positive surprise. So showing this resilience, and showing that, I think also to some extent, it was European companies that actually benefited, and that sounds strange, but they benefited from the closure of the Strait of Hormuz. Why is that? Because Asian competitors were hurt more relatively than the European firms, which meant that some orders could not be kind of put into production in Asia, and then were transferred to Europe. So this explains why Europe has been, at least to some extent, even a beneficiary of the closure of the Strait of Hormuz.
Okay, yeah, I want to delve into that as well. But Carole, we saw this roller coaster of oil prices, oil topping $100 a barrel and then coming back down again. What is the fact that we saw these high energy prices on the one hand tell you about the fact that we actually have some positive economic news out of Europe on the other hand? Does this show maybe resiliency?
It definitely shows that you are able to better confront and deal with energy crisis than perhaps a few years ago. And I have to be careful when I use the word crisis, because I feel it has been overused, and the threshold that we use as economists, for example, define what crisis is, has been really distorted, because at the sign of any kind of increase in oil price, people immediately start to talk about crisis. I saw these over-ambitious forecasts for oil prices, for example, when the Iran-US conflict started. People were talking about $300 oil price and beyond. I mean, really sheer madness. And none of that happened, as if we cannot believe that energy markets have evolved. And it's something I would like to remind people of. It's not just about one region, such as the eurozone, or one country doing things better than anybody else. It's just simply a fact that energy markets have evolved dramatically over the last few decades. They have become much more diversified, not only in terms of energy sources, not just because of green energy, including nuclear, but also renewable energy, but also the diversification of suppliers. Today, it's not Saudi Arabia, which is the largest producer of oil in the world. It is the US, which is also the largest LNG exporter in the world, and all happened over a short period of time. So lots of structural changes that are creating, in the midst of a conflict or a crisis, we are not seeing the same economic consequences as, for example, we saw in the 70s and the 80s, even though back then the disruptions were much smaller. So we have to keep on reminding ourselves of these fundamental or undercurrent that have been happening over the last few decades, and that is creating the kind of outcome we are seeing today. And it's not just because of one country's clever policymakers, it's just the nature of markets changing and evolving.
So it sounds to me like you're saying maybe, we shouldn't be patting ourselves on the back here in Europe necessarily, that maybe the hard lessons have not been learned this time, and there could just be an evolution from the last crisis. And you put that in important context from just a few years ago, the war in Ukraine. Am I understanding that correctly?
Certainly, I don't want to be ungrateful and say that policymakers did not enact any effective policies. On the contrary, actually, I have to say that in 2022, what the EU did in reaction to the war in Ukraine on the energy front and the economic front was quite impressive. I mean, remember that we're talking about a region which took years and years to agree on a common energy policy. And then suddenly in 2022, we saw the EU coming together and speaking in one voice. Even Germany, where I'm sitting today, I mean, it was amazing to see them taking a very strong stance against Russia, even though Germany was the biggest market for Russian gas, and Russia for Germany it's the biggest supplier. So I don't want to say they haven't done any important, they haven't enacted any important policies. They did, and I really admire for what happened in 2022. And today we are reaping some of those benefits. But to give the kind of resilience we are discussing entirely to those policies is very, very simplistic. It's actually, if those policies happen in different market conditions, I don't think we would have seen the same reaction. So just to give you an example, LNG. The reason why the EU was able to sever its connections or relationship with Russia is because LNG markets have evolved, is because the US became the biggest LNG supplier. You wouldn't have been able to sever that relationship with Russia perhaps 20 years ago because you were still relying heavily on pipeline gas. So I would say I would put first fundamental market changes, and second, changes in policy side that build on the momentum that we have seen in energy markets.
Carsten, perhaps rightly you point out that maybe my sunny American disposition is popping out a bit too strongly with the reading of this information. So maybe I'm a bit glass too half full. What's the glass half empty case here? Is it something as pessimistic as, the whole system is just a house built on sand, or what's your take?
No, I wouldn't say that this is a house built on sand. I think we don't have all technical components of GDP growth in the second quarter yet. But what I see is more or less a growth that was driven by exports, and that is not to do any shoulder padding, because it had nothing to do with economic policies. This is more because the Asian countries are simply more dependent on energy coming through the Strait of Hormuz than the European countries. But that is temporary. When you then look at investments, for example, at least in the countries where we do have some details, in investments in the second quarter disappointed, and I think that is clearly a warning signal that should also clearly, subdue your American optimism a little bit, because if we don't get investments back to Europe, it is clear that we won't get a restoring of competitiveness, etc., etc. What we also saw is, for example, that private consumption was weak, grew apparently a little bit, but clearly also suffered under the higher energy price. If you then look ahead, second half of this year, if you stick to this glass half empty story, what is half empty is, we still have high energy prices. Actually, we have higher energy prices than in in June. That is one thing. We also have clearly the heat wave in Europe. We have low water levels in many rivers, which can lead to more supply chain frictions again, meaning disruptions, also lower growth, higher inflation. So all these are clearly still cyclical headwinds. To more or less fuel your optimism a little bit, we're still waiting for the fiscal stimulus in Germany to come through. If this happens, I think then there's more reason to be again a bit more enthusiastic. And then also before the war in Iran started, we had the European leaders actually agreeing and promising on structural reforms, strengthening of the single market, strengthening of energy policies, reducing bureaucracy. So if European leaders were actually to push through on all these measures, then I think your American optimism would be more justified.
Speaking of optimism, I'm wondering if this time period we're looking at, Q2 of this year, was maybe like a sunnier time, right? So Q2, of course, covering the beginning of April to the end of June. June, we were seeing this memorandum of understanding between the U.S. and Iran, and that was put in place at the end of that month before it fell apart in July. So I'm wondering, is this data, Carsten, maybe a bit too early of a reading? Is that why it's skewing towards optimism?
Yeah, Cassandra, learn from central bankers, and central bankers will always tell you that they don't derive any policy action just based on one data observation. So clearly, I think we shouldn't now give the all clear to the European economy only because the second quarter was better than feared. You're fully right. I think that the second quarter masks quite some interesting and also volatile developments. Remember that actually at the start of the war, and that is still March and April, we saw enormous stockpiling. So that also led actually to economic growth because all companies had learned from the war in Ukraine, namely started to stockpile. So that was good also for economic growth. Then May was a bit of disappointment. June was already then, at least in parts, weeks with the memorandum of understanding, dropping energy prices, everyone hoping that the war in the Middle East would disappear very quickly. So it could very well be that the big negative shock still comes now in the third quarter. But obviously, we all know this depends so much on the war in the Middle East, on energy prices, and energy prices are currently, fluctuating by $5 per barrel on a day. So it's impossible to derive any useful forecast from these energy prices right now.
Carole, energy has really been an albatross around the neck of Europe for a while. We saw it, as we've been talking about, with the full-scale Russian invasion of Ukraine. Has there been significant movement towards energy sovereignty in Europe?
I'm not quite sure what you really mean with energy sovereignty. If you mean energy independence, you see, I don't believe that energy independence really gives you the energy security that people think can be achieved. First of all, I don't think you can achieve full energy security because problems can arise here and there. But just to give you an example, imagine if Japan, when the Fukushima disaster happened, imagine if Japan had no import policy at all, or no strategy to import gas from elsewhere. It would have been a big disaster for the Japanese, but it was LNG imports that saved the day. So we have to be very careful here when we talk about energy sovereignty, irrespective of what really means, because it can encompass different dimensions, but I'm limiting it to one aspect that is often considered as energy independence, which means you don't want to import anything from other countries. Of course, when you have energy imports, you feel you are more vulnerable because you are more exposed to what's happening beyond your borders, and that's why you feel you have less control of over your economy, over your industry, over prices, etc. But this is a fallacy, I would say, because at the end, what history tells us is that energy security can be achieved by diversity and diversity alone. And I have to say that the Chinese have kind of, I don't want to say mastered, but they seem to be acquired a very good understanding of that concept because they rely on both. I mean, of course, there is a caveat here because of the size and the demand of the Chinese economy to energy sources, but they are putting a great emphasis on on domestic energy sources across the board. So no favoritism for one particular source of energy. They are investing in oil, gas, coal, nuclear, renewable energy, you name it. But they are also diversifying their import sources. So you rarely see them depending or putting too much faith in one supplier, because they know that will make them more vulnerable. So they diversify their sources of supplies as well. The support for technological developments, all these. So there's a lot to learn from them. And therefore, that's the kind of concept of energy diversity and diversification of both sources and suppliers that should remain the focus of any healthy energy policy going forward.
No, you're right to call me on that buzzword, Carole. I try not to use them. But Carsten, are you expecting any action from the ECB or other governments coming up, or what can we expect the fall to look like?
Yeah, I think not a lot, Cassandra, because there were a few packages, some government interventions in May and in June, tax rebate in Germany. Also, Spain did something to lower gasoline prices, but that's pretty much it. If you look at the total sum, in 2022, I think European governments had more than 500 individual measures amounting to something like 3 to 4% of European GDP, just to stimulate the economy, just to cap energy prices. Currently, we stand at 0.2% of GDP. So I don't expect really a lot more coming, and which is good, because I think the European economy rather wants to see actually consumers, companies to adjust to higher energy prices. We will clearly see more of the structural measures, namely putting more emphasis on renewables. And then you mentioned the ECB. Obviously, the ECB is still completely haunted by the inflation wave of 2022. So they will hike interest rates in September. Not that it will bring down energy prices, but at least it gives the ECB a good feeling.
Carsten Brzeski, ING, you're a busy guy. We have to let you go, but thanks for making some time for us on The Dip.
Thanks for having me.
And because energy is such an important part of the story, I want to stay there with Carole Nakhle from Crystol Energy. Carole, the Strait of Hormuz, it's not just an important transit waterway for oil and fossil fuels, but it's also a critical passage for a lot of other goods. We've been talking about that already. But what kind of inflation could we potentially see here if the blockages remain? Would we expect inflation to just hit energy or other parts of the economy as well?
I mean, look, there is no doubt that energy prices will affect the economies everywhere, because if you look around you, you are surrounded by products that come from oil and gas in particular, but also the electricity supplies, the petrochemicals industry, and other goods and that goes through the Strait of Hormuz. But let me keep the focus here on energy. Of course, any kind of sustained disruptions when there are no other alternatives to ease or compensate for those disruptions are going to put sustained pressure on prices. And those prices, the longer they stay high, the more we start feeling inflationary pressure persisting. And that's why it's very important to take into consideration this important fact. It's not just every time we have a spike in prices. Look, you have global energy markets, you have geopolitical tensions everywhere, you still have a war ongoing in Ukraine, you do have the conflict in the Middle East, and elsewhere you do have tensions arising. So you need to expect volatility all the time, but volatility is not necessarily vulnerability. The key question that us economists ask is not, for example, how high prices can go, but actually how long will those high prices remain in place before we see them filtering through something more sustainable in the economy. So you need to see a period of high prices for several months continuously before we start talking about some serious inflationary pressure. And that's why I'm not too worried today. I know there were concerns at the beginning of the conflict, but we have seen diversion of some of those products going to elsewhere. We have seen supplies coming from elsewhere. We also see demand adjustment mechanism, whether through government policy or simply consumers reacting to higher prices. So far, the inflationary fears that were at the beginning of the conflict have not materialized. It does not mean that if the conflict does not, for example, escalates and we have much more severe disruptions that last for months and months and months, then we start to be more worried about inflation and crippling inflation that requires more drastic policies, as we saw, for example, in the previous recent years.
Carole, just a couple more questions for you. I'm wondering, at the beginning of this conflict, we were hearing, because energy prices were so high, that there's possibly demand destruction, that whole-scale industries or businesses might be moving their energy demands to other sources. And then when oil would come back to a cheaper price, it just wasn't there anymore. The customers had kind of moved on. Is that part of the story here, or was that kind of a Peter cries wolf situation earlier on in the conflict?
That is definitely one of the most important pillars of the evolution of energy markets. And this is actually the least understood. Why? Because it's very difficult to quantify and to put a value immediately. And often we see some kind of lagged reaction, which means we don't see the impact straight away. It becomes visible later on. And actually in energy economics, we have much better understanding and ability to model supplies than we do for demand. So this is really what we are. But if we learned over the last crises, for example, throughout the history of energy markets, we see that demand destruction is quite real and strong. We distinguish between two things, and apologies for the technical jargon, but there is something we call behavioral destruction, which means that because prices are high, I don't drive my car. When prices go down, I go on very long road trips. So that is us reacting just temporarily to changes in prices. But there are more powerful change, and I think this is what you're referring to, is the structural destruction in demand, whereby that once prices are high, we lose demand simply because we change behavior. I sell my gasoline car and I buy an electric vehicle, for example. And therefore, even if prices go down, guess what? I'm not going to sell my EV and buy a gasoline. I continue to drive EV. So that is what we call structural destruction in demand, that once lost, it doesn't come back. And this is something actually that is very powerful, and it's one reason why we're seeing that the economies are able to adjust better to high energy prices, because we're not drinking oil or burning gas like crazy as we used to do not long ago.
Carole, we're seeing the effects of climate change very strongly right now in Europe, with wildfires in France and Spain, at least at the time of this recording. I'm wondering, there's been talk from leaders for a long time about the energy transition, this need to move away from fossil fuels, but this war, I'm now hesitant to use the word crisis because of our conversation, but this war in the Persian Gulf has caused another energy spike. It makes me kind of zoom back and wonder, has the energy transition in Europe failed, or at least failed so far?
The energy transition, the very first definition that people everywhere adopted, and that was in fashion before 2022, actually before also the COVID-19 pandemic, that has failed. Why? Because government set very ambitious targets, really unrealistic targets. They were trying to achieve something that we have never been able to achieve in the history of mankind, in terms of scale, in terms of speed. So that has failed. Today, there is a modified version of the energy transition. The train has left the station, so we are in that direction. We did not reverse it, but what we did, we modified the approach, and it has become more pragmatic. We have come to accept that this energy transition, where suddenly we're going to move away from our dependence of more than 80% on fossil fuel, and then suddenly move on to having everything coming from the sun and the wind and nuclear and the water within a question of 2-3 decades. That does not exist, because it's not technically possible. No matter what governments will do, that is technically not possible. And people realize that that ambitious target would translate into higher energy prices. It comes with a high cost. It comes with high financial burden on the government. So that was actually modified. And today we have a more pragmatic approach. And that's why we hear people talking about addition, energy complementarity, not substitution. So I am one of those who believe that no, we have not abandoned the energy transition. We are still heading towards a greener, cleaner future. And look at oil and gas companies, for example. Yes, they may have abandoned some renewable targets, at the end, what makes them better than others to produce solar power or wind power, but they have not abandoned clean projects such as carbon capture and storage and reducing the carbon intensity of their oil operations, because they know that that will give them the competitive edge in the future. So there is recalibration, but not abandonment or complete U-turn.
Last one for you, Carole. Briefly, optimism versus pessimism has been kind of the tension throughout our conversation, and also our conversation earlier with Carsten. For the rest of 2026, and thinking about how the European economy has been faring so far, are you more glass half full or glass half empty?
I start to get a little bit worried when we enter the winter period, only because, in terms of energy demand, you increase the demand, let's say, for natural gas, because you have to fill your storage. You start competing with other, let's say, other important importers such as Asia, and also on oil. So there are lots of things that give a boost to energy demand. And if there is a geopolitical tension in key producing regions, that is concerning. But personally, I always see the glass half full. I never looked really at the empty side. I prepare for it. I try to take precaution. But when you are sailing in the fog, when you are actually driving in a thick fog, you don't stop driving. You continue, but you are a bit more cautious. So let me leave it on this positive note.
Carole Nakhle from Crystol Energy, thank you for joining us on The Dip.
Thank you, Cassandra.
That's it this week from The Dip. I always love getting your questions or comments, so go ahead and leave those wherever you're watching or listening to us right now. And of course, if you have a really long question or comment, or just something we should know about, go ahead and send us an email at thedip@dw.com. And I haven't asked this in a while, but if you're not yet a subscriber, please just go ahead and slam that subscribe or follow button. It really does help new listeners find us here at The Dip. And if you want our full playlist, or to see wherever our podcasts are found, you can scan the QR code. I was pointing to it, but I'll point to it again. You can scan that QR code that's appearing on your screen right now. But that is it. I've been talking for a while. That is it from me and the crew here in Berlin. Thank you so much for watching The Dip.